If you're aiming to live off $100,000 a year from rental income, there's a straightforward formula that can help you get there: a 7% cash-on-cash return. This is achievable, and today, I'll break down how to make it happen. Here's the math. To generate $100,000 annually with a 7% return, you'll need to invest around $1.4 million into real estate. However, it's crucial to focus on three essential factors when it comes to real estate investing: location, property type, and numbers. I'll cover each one in that order to give you the roadmap to success. Step 1. Location. From my 13 years of experience in real estate, the first and most critical step is understanding the location. When evaluating a location, consider where businesses are moving, where people are relocating, and where capital is flowing. These three factors usually align. When businesses move to an area, jobs follow, bringing more people, and eventually the money follows too. So, how do you find where businesses, people, and money are headed? There are expensive publications that track these trends, but there's also a simpler, hands-on approach. Walk around neighborhoods you're interested in and visit local spots like coffee shops. Ask the barista, "Do you live around here?" If they do, ask what they like about the area. If they don't, ask why not. Their answers will give you insight into the area's appeal, or lack of it. But before diving into neighborhoods, consider the city and state as a whole. Some are more landlord-friendly, while others are more tenant-friendly. In tenant-friendly states like California, evicting a non-paying tenant can take months or even years and cost a fortune. In landlord-friendly states, the process is often quicker and less costly. Besides tenant laws, look at the area's growth trends. Use a quick Google search to see if the population is increasing, stable, or declining. Invest in places where people are moving in, or at least where the population is stable. Declining populations mean lower rental demand, which can hurt profitability. Step 2. Property type. Once you've identified a good location, decide on the type of property. Generally, properties fall into two categories: turnkey and value-add. Turnkey properties are ready-to-go investments like fully rented apartment complexes or single-family homes that are renovated and require minimal work. They provide lower returns but involve less risk and effort. Value-add properties, on the other hand, require work. Think vacant apartments or distressed single-family homes. Although these properties come with higher risk and the need for renovations, they offer higher potential returns. Value-add properties are my preference because of the potential to revitalize communities and generate substantial returns. If you're not up for dealing with renovations, contractors, and permitting, turnkey might be the way to go. But remember, with higher risks and value-add deals come greater potential profits. Step 3. The numbers. Once you've chosen a location and property type, it's time to crunch the numbers. Calculate cash flow by taking the rental income and subtracting property taxes, insurance, maintenance costs, management fees, and a vacancy allowance. Here's a quick breakdown. Property taxes, 15% of rental income. Insurance, 5%. Maintenance, 8%. Management fees, 8%. Vacancy, 8%. This back-of-the-napkin calculation can help you estimate your net operating income, or NOI. If you have a mortgage, subtract that as well. I aim for a 7% cash-on-cash return, meaning that if I invest $100,000 in cash, I expect at least $7,000 in profit after expenses. I don't just buy in any location. I focus on areas with population and business growth, which support rising rents and property values. Property appreciation is a bonus, not a necessity. I structure my deals with enough margin so that even if rents fall during a recession, I can stay profitable. Generating generational wealth. Instead of passing down a heavily mortgaged property, real generational wealth is created by building a portfolio that generates cash flow and appreciates over time. Start by investing in properties that meet your goals, then reinvest as your income grows. You don't have to buy it all.